So you are not. I'm not supposed to continue with a new concept like the next day, but it wasn't really a big one. It was something with. It's a combination of what we've done already. That's liquidities and other blocks with trend. So today we'll just continue from fair value gaps. As I said, what we did the last time on fair value gaps was identification and then how to mark out the entries. Am I correct? Did I show you how to mark entry, stop loss, and take profits? Anybody from the last class on fair value gaps?
No, no, no.
Oh, really?
I went through the video on the fair value gap from the last class, and what I can remember you did was just the introduction to the fair value gaps, how to mark it out correctly, the bullish fair value gap and the bearish fair value gap, just like that, like that. And you
Okay.
were trying to um, use that part to draw how we can use it to get an entry, but you did not go into it in detail, just the introduction to the fair value gaps.
All right. Thank you. So, what we'll be doing today is how to mark the entry, stop loss, and take profit. And maybe we can now touch. Okay, let's just start from there. Give me a minute. So, fair value gaps continuation. So, when we have a fair value gap like this, as of now, we all know what a fair value gap actually is, what causes a fair value gap, and how to mark a fair value gap. Bullish and bearish fair value gap, marking fair value gap with a Fibonacci, right? The last time I showed how to mark it with a Fibonacci, FIB retracement. Am I communicating? Can you guys hear me?
Yes, I can.
Yes, we
I
can
said
hear you.
I did with Fibonacci, right? That's this.
No.
Really? I only showed how to mark it with rectangle. Is that what you're saying?
Yes, you just told her to just mark to connect the three candles. That is all. You tell you the
Yes,
setting
yeah,
of the national.
yeah. He didn't show it with the Fibonacci.
All right. I guess that's the two things we are going to do today then. So I think I should even not draw. lines. Let's just dive right in. So here is a so this is a bullish fair value gap. Is either you connect it with a rectangle. As I said in the last class for fair value gap, it is a consecutive three candles. It has to be a triple candlestick formation. If there is no triple candlestick formation for a fair value gap, then there's nothing like fair value gap in the first place. The large candle will always be the second candle. Let me do a little refreshment. I said refreshment. Refresh. The first candle will be the first candle that actually formed. The second candle is the middle candle, that's the large candle, and then the third candle will be the third one here. So this is the number one candle, then number two, number three. The number two will always be the middle candle. Even if it's a bearish candle, even if it's a bearish fair value gap, it will be the middle candle. Then another thing is this bullish fair value gap does not necessarily have to have everything must not be bullish candle. This third one can be bearish candle. This first one too can be bearish candle. But the dominant ones, like once you have a bullish fair value gap, two dominant candles must be bullish at least. The two cannot be bearish. You can't have a bearish candle here and a bearish candle here, and maybe it's only the middle that is bullish. No. But if you have just one bearish candle here, you are good to go. It is still a fair value gap. But the whole point here is two dominant fair value gap, like bullish fair value gap, should be present here. So now that we know what the fair value gap is and how to mark it out, what we are doing is connecting these lines, connecting the 2 weeks together. The space in between is our fair value gap. So apart from marking it with a rectangle, this is how you use the Fibonacci. You go to your Gann and Fibonacci. That's Gann and Fibonacci. And then you click on FIB retracement. But if you don't want to be going through that straight every time, you long press on your Fibonacci or any tools you want to add to your favorite. Then you click. It's already on my favorite, is why it's showing remove from favorite. Hold on, I'm trying to show you guys something. So you long press. Once you long press like this, it will show you remove from favorite or okay, let me remove. So once you long press, it will show you to add to favorite and you add to favorite. So now you don't need to go through the stress of going for Gann and Fibonacci anytime you want to mark it. You can just go to your favorite. As you can see, these are my favorite here. So you click on the FIB retracement, that's the Fibonacci. And what we are still doing here is connecting the 2 weeks. So from here, you see now I've clicked on I've clicked on the Fibonacci, and then just like the rectangle, you start from one of the weeks and then you try to connect it to the second one. Is that simple? Okay, let me not confuse you guys. You click on your Fibonacci. This is the first week. You connect to the third week. Just same way you are going to mark your rectangle. So as I said for the rectangle, I said you are going to adjust it to the right a little because that is where price will eventually try to like mitigate it from. So just for it to be cleaner or clearer, you can just adjust it to the left to a little. So your lines and everything will be obvious. So for now, let me delete this. For now, this is our bullish fair value gap. So of course, I would have talked about the three zones of fair value gap: the surface level, 50%, and the extreme, right?
Yes.
Yeah, very good. So this Fibonacci is used to separate them and is used for better risk to reward. So now this is the surface level of mitigation. This is the 50% or middle. Then this is the extreme or finish. No, let me not use finish. The extreme or bottom of the fair value gap. So whenever we use Fibonacci, we are trying to separate surface from the 50% from the bottom. So whenever we do this, we have a better risk to reward. So let me do this example. I'm actually surprised I did not mark out with a Fibonacci. But yeah, so we're connecting these two lines. So now let's talk about how we mark the entries. So from here, we have a bullish fair value gap. So what you are going to do is click on your buy position, because of course, for a bullish fair value gap, that means we are trying to buy. That means we are trying to buy. So on your surface level, or let's say the beginning of this rectangle, same way you mark another block, you come here and you place your buy position on it. So as you can see here, we have our stop loss, our entry, and our take profit. So where do we put our stop loss? Where do we put our take profit level? We've already confirmed where we are supposed to put the entry. Whenever you mark it out like this, you place your entry here, where price is expected to mitigate first. Okay, so now our stop loss will be below or around the first candle of the fair value gap. If it's bullish, it will be the first candle. I think if it's bearish also, it will be the first candle. Yes, actually. So your stop loss will be here. So it will be around there. So that's what we have now. And your take profit is supposed to be at the next high. For now, like let's say we found out this fair value gap around here. This is where the take profit will be. I'm still going to teach how we can extend our take profits on a normal day. On a normal day, your take profit is not supposed to, your risk to reward is not supposed to be anything less than 3 risks to reward for fair value gaps confirmation. But we are still getting there. But let's say this is 1.89. These are your mark your entries, your TP, and your stop loss. Same way for other block, that the next high for target, that the next high will be your target. The same way it is for fair value gap. So on this time frame, that was the next high. On the 30-minute time frame, that was the next high, and that was used as our target. And as you can see, why I said we need this as our stop loss. So on a random day, no, let's not say random, on a regular day, this is our entry for the fair value gap. For the fair value gap and the stop loss and the take profit. So all we expect is for price to mitigate and go to our TP, right? So now let me show you why we use Fibonacci. So for instance here now, the fair value gap stop loss is big, like is large, okay? So what we are trying to do is refine, something called refinement. Oh, I think the second confluence I wanted to do was order block refinements. Now I remember. order block refinement, and then it would have from order block refinement to valid and invalid order block. On the next session, I'll show order block refinement. It's a very simple concept. Or have I
No,
taught
boss,
it?
you have shown us other block refinements.
Oh, I've shown order block refinement. Oh, all right then. All right. So I think it's raining outside. It was raining before I got inside because my network is now bad. But we should be able to get this done tonight. So don't forget, this is 1.89 risk to reward, or let's just say 1.90. Let's just say 1.90. So this is 1.90 risk to reward after we've used it the basic way it's supposed to be. But we want to refine it for a better risk to reward. So what we are doing is deleting this, and we are using our Fibonacci. So you bring your Fibonacci, that's FIB retracement. You try to connect it from here. So yeah. So your entry now will be at the 50%, not the surface anymore. So we are bringing our entry to 50%. So this refinement is for a better risk to reward and sometimes to be safer. But let's just say for a better risk to reward. So of course the stop loss is at the same place, and now our TP also at the same place. So now we went from 1.1.90 to 2.57. So watch what happens from here. So instead of booking 1.89 risk to reward, we are booking 2.5. That's what I mean when I said better risk to reward. Okay. Now let's look for another example. Another example is right here. Actually, I didn't just want to talk about this yet, but I really will not want to say it now, so you guys won't get confused. But basically, when we have two fair value gaps like this, when the two candles are like this, bearish and bearish, the only scenario when you can still go for that fair value gap is when you have a large candle like this. This one is called hold on. I should remember. Liquidity void. So it's a type of fair value gap. Most people will say it's not a fair value gap, is liquidity void on its own. But it is actually still a type of fair value gap. A liquidity void is a very long or large middle candle. Like it can be extremely long. Like that kind of impulsive move is very, very high. Like the spike will be very, very high. So when it's this long, it will make up for whatever two candles you have, regardless of the color. I can show other example, maybe after we have marked this one. So for liquidity void, the liquidity void just know is a longer fair value gap or a larger fair value gap. The middle candle is always long. So in that scenario, you can use the fair value gap. You can go on with the fair value gap. But most time when it's a normal fair value gap, not a liquidity void, like this our first example, you are supposed to not use it. It can be used, but it is risky than the normal one. It is risky than the normal one. And this one today, when someone asks why I did not drop this entry, I didn't drop this entry, this particular one, this one here, this middle entry here, because of this same thing. There were two bullish. Okay, let me just show you. So most times they are not strong enough to hold for long, or sometimes they don't even hold. So as you can see, this is not a liquidity void. Liquidity void is not the third candle being long, it's the second candle being long, being large. Let me just put it that way. So I didn't draw because it was not really looking good. But fortunately, it played out and took out the next low. That is our normal target, but it didn't hold for long. Maybe if it was actually a proper one with like the full candles are bearish, probably it would have played out better, like hold for long. But this didn't hold for long. But in normal day, this is the take profit. It played out. Nestle is supposed to be your target, so of course it actually played out. But I'm just trying to show you guys why sometimes you are not supposed to use it. In fact, it's when we get to the advanced level that I will show you, okay, this is how you are supposed to, this is when you're supposed to use it, and this is when you're not supposed to. So for now, we are still working on the refinement and marking the entries and stop loss plus take profit. So once again, this is another example, a bullish example. Of course, it is large. So we don't even need to be pondering on should we use rectangle or the Fibonacci. Clearly, it is a large one. That's a liquidity void. So we are connecting the wicks once again from here to here. So where's our entry going to be? Entry will be here. Stop loss, of course, around this candle. And then our take profit will be the next high. I think the next high is somewhere around here. So that's 2.69. But if we are supposed to use the surface would have been here. Stop loss would have been here. It would have been 1.75. So you can see the usefulness of using a Fibonacci. So we went from 1.75 to what? To 2.84. So I think this is the recent whatever that is playing out. But anyways, these are just examples of how to mark this fair value gap. This is not me saying I took this trade. This is not me saying I took this trade or I'm currently on the trade or I'm telling you guys to take the trade. No, these are just examples. So as I said, these are just examples. So let's look for bearish examples now. So this is a bearish fair value gap. So this is a bearish fair value gap. Do I need to mark it? Okay, let me just mark it. So you click on your Fibonacci once again, your FIB retracement. You connect the wicks. And of course, this is the 50%. For bearish, this is the surface, 50%, and the extreme. Okay, so we have our entry here, our stop loss somewhere around here, and take profit actually is supposed to be the next low. So if it was surface, this is 2.9, almost 3 risk to reward. But if it was surface, this is what it would be. It would be 2.21. No, the TP will be here, so it will be 1.91. But because we use the surface, no, because we use 50% for refinement and better risk to reward. So almost 3 risks to reward. So what we'll wait is for price to mitigate and take out the next low. That's an example for a bearish one. For a
Okay.
bearish fair value gap,
Sorry, please, can I ask a question?
of course.
Okay, I can see that, yes, I understand that this is just an example as well. But I noticed that there are two fair value gaps at that. Why are we not
Yeah,
using the one?
sorry that I'm interrupting you. This is an example. We are not there yet.
Okay.
We are not
Okay.
we are not the aspect where we say, oh, this is a fair value gap to use and this is not a fair value gap to you. This
Okay.
is
Okay.
just an example. Yeah.
All right. Thank you.
So um sorry.
Please, can I ask a
Let's
question, bro?
do yeah, no problem. I can hear you.
Okay. Okay, please, sorry. I was actually going through a particular video that was last week. Since after I paid for the mentorship, I was like, okay, let me start learning things about FVG. So there was a particular video I came across, and then with the way there's a particular FVG that forms, and then I think the guy said it's called breakaway gap. That's not an FVG. The market most of the time does not actually come into that zone, and even if market comes into those zones, it does not actually react very well.
Yes, I said breakaway gap. Or it's not my video you're talking about. Are you there?
Yes, I'm here, boss. It was not your video.
So what did the person call the breakaway gap? Was it a
No,
small one?
no. For example, I think we always pay attention to the third candle, the formation of the third candle to determine the FVG. But then in a situation whereby the third candle opens, let me say, has the same length as that of the second candle. That was what he was saying, that that's actually a breakaway gap. That most of the times price does not actually come back there, and even if it comes back, it might actually break through and then go in the opposite direction.
Actually, that's not my own definition, especially for my own type of strategy. I don't just this is me talking about uh how to market out the entry, stop loss, refinement and everything. When we are getting to the valid, invalid, the ones that feel true, the ones that are likely to reject, and my own fair value gap is even mainly based on confirmation and continuation, not just any fair value gap. So if we are talking about the type of fair value gap that price is expected to return to and then reject or whatsoever, then we can be talking about the length, the whatever. But for me, that's not my definition. In fact, I don't really go for which if the length is the same as netting. Nah, that's not my definition at all.
Okay, boss. Thank you
So
very
if
much.
it's
Thank you
not,
for the
yeah,
clarification.
yeah, yeah. So let's just look for another bearish example. And then what I would chip in here is stop loss refinement for all the examples we have had so far. And after that, then we can move on to the next confluence on fair value gaps. Let's just do this. Let's just do this. So I don't think I need to mark anything. Can you see it? This is a bearish fair value gap. What did we do here? Click on our Fibonacci, connect this line to this line. Our stop loss at the top of the first candle. Don't forget that the first candle is the candle will always be the candle that forms first. The second candle or the middle candle will always be the second candle. The middle candle will always be the second candle. Then the third candle is the one that forms last. So our take profit is our next low here. On a normal day, is supposed to be the next low. But for extreme target, that's 4 hour target, we took it here. I'm still going to teach how you can extend your target levels. But for now, let's just show how it works. So we expect a price to reject back to the entry and no, return back to the entry and reject. I think this was another example while that one was playing out. This one is called a continuation entry, not confirmation. So let me show you something. So around here, as you can see, so this is a 5.02 risk to reward. Okay. On a normal day, this is where the stop loss is supposed to be. Let's do it properly. So this one is called stop loss refinement for fair value gap. Now, sometimes you can use 50% just for a better risk to reward, and maybe, just maybe, your risk to reward is still not enough for you. It's still not looking okay for you, not very well presentable for you. So this is what we're going to do. We are using 50% for here also. Now keep in mind before I move further, when you use FIB retracement on a normal day, prayer is supposed to mitigate surface of a fair value gap and play out. But most times it goes to the 50%. So just know that sometimes when you use 50% of a fair value gap, you are opened. Like, it is very, very possible, 50% possible, 50% chance that you might miss that entry, because price can just mitigate the surface and play out without returning to the 50%. Like, price can just come here, mitigate the surface here, and just play out without mitigating the 50%. So there's still some areas I'll get for in fair value gaps where I'll tell you, oh, that's for higher time frame mitigation. if you can do your confirmation from just surface or from the 50%. But anyways, we've marked out the fair value gap, and we are marking our entry, which is a bearish short position. So what we'll do here is bring it to the entry, and of course stop loss is supposed to be here. Let's say take profit is supposed to be here. Well, there was another daily target here, so let's just use the daily target. So let's say this is giving us 3 rigs to reward. Can you see that? 3 rigs to reward. But one thing you will notice about this stop loss is it is still big. It is still very, very big. So after all these pips, it is still looking like it is just 3 rigs to reward that will be able to take home. So here comes the other refinement for stop loss. So this stop loss refinement. Now, same way if you refine your entry, you might miss entry. Same way for fair value gap. Sometimes if you will refine the stop loss, you can still hit. If you refine your stop loss, you are opened. There is an higher chance of you hitting your stop loss because sometimes, okay, let me just show you. So this is how we refine it. Same way we use Fibonacci to divide this fair value gap. You are just going to divide this first candle into 3. So what you are going to do is the start of the candle and the close of the candle. We are just trying to divide it into 50%. There's nothing complicated about it. Let me show you once again. What we are doing is you click on your path tools, click on the Fibonacci retracement, start from either the close of the candle to the open of the candle, or the open of the candle to the close of the candle. The whole point is we are trying to divide it into 2. So we divide it into 2. So your stop loss will now be here. Now don't forget this was 3.02 before for risk to reward. But once we bring it here, it becomes 5 risk to reward. So if you are familiar with my entries, it will make sense to you that sometimes when it doesn't mark the stop loss in a way or whatever, this is what I did. This is me refining the stop loss. But just know that you are opened, like you are not following the basic or the normal way. You are trying to refine your entry. You are looking for a better risk to reward. So there's an higher chance of hitting stop loss. And this is what I mean by that. No, let me not say higher chance. Let's just say there is a chance, a bigger chance that you might hit SL compared to if you actually use the normal SL. So if the SL is here, or it have made a mistake. So if the SL is here, now it has given us 5 breaks to reward. We are ready to go for 5 breaks to reward. Okay, but here's one thing with it. Sometimes price can feel all the way here. Feel here and get here and still play out. So, but if you use the normal SL, that's if you put your SL here, then that means you won't have hit SL. So do you understand what I mean by higher chance of hitting SL now? Let me not use higher chance once again. Like a bigger chance compared to using the normal stop loss. So once we have it this way, we want to refine, right? We want to refine. So we've refined our entry and we've refined our stop loss. So now we have 5 breaks to reward. So let's wait for it to play out. So moving forward, this is how your refinement is for stop loss and entry. So let me just show you guys today's an example that happened today. So that's a fair value gap. And on a normal day, the entry will be here. It is a bullish fair value gap, so the entry will be here. Stop loss will be here. Take profit here. But if this is a big SL to you, if this is looking like, oh, this is too big, once again, what are we going to do? We are going to divide this first candle into two. So you bring it here, and we divide into two. Hold on. This is the first candle, right? So from the open of the candle to close of the candle. So what are we going to do now? We are going to put our SL at the 50%. So basically, it's just like dividing the first candle for a better risk to reward. So what was the TP before? The risk to reward was around 2.64 before. But the moment we did that, we got 4.3 risk to reward. So now our risk to reward has been increased. And that's the whole point of stop loss and entry refinement. So the next one is this. But most times when your SL is okay, when your SL is not looking too large, just go on without refining and over refining. So same routine, we want to divide this candle. On a normal day, we won't have divided this candle, but the stop loss is still very large. So we want to divide the candle. We are not supposed to divide the candle because it's a small one. So as you can see, we want to use 50%. We want to group it into two. So now we have it here. So I don't know, we went from, sorry, hold on. Yes. So this was what before, this was 1:6, that's 1.6 risk to reward. But the moment we use this now, we have 2 risk to reward. So basically, these are you refine your entry, your take profit. No, these are you refine your entry and your stop loss. So any questions on everything we did today? We actually said like 4 things about fair value gaps, or 5 just tonight. So any questions? I'm about to round up.
Yes, I have a question.
Go on.
How do you mark the fair value gap using the Fibonacci method? Because when I click that Fibonacci method, I used to see other
Oh.
lines like 70 and all those things.
Yeah, that's a good one. So once you click on your Fibonacci, it won't appear this way. Okay. So what you do is double click it. You double click. Once you double click it will bring it like this for you. So once you double click, if you've not used Fibonacci before, you've not had the settings, every line here, everything here might be marked. Almost everything will be marked, or let's say will be ticked, whatever English. So this is closely what it will look like. Most will even have colors if you've never had uh if you never use Fibonacci or resetting it or whatever, some will even have color, a lot of colors. But on a normal day, this is what it will look like. So this is how you do it. Once you double click it, you are going to unmark every numbers. You are going to untick every number, only 0, 1, and 0.5. So we are unmarking everything. So what you are going to do is on your chart is unmark everything. You double click and you unmark everything, only leaving 0.5, only leaving 0, 0.5, and 1. Can you see that? So immediately you've done that, it will return to 3 line. It will just be 3 line. So another thing is if it has colors, yeah, I think this is how you do it. Yeah, use one color. As you can see, they said use one color. So using one color, you can pick any of your desired color. Or use one color. I used black. So do you now understand how you mark it?
Yes, yes, well understood.
Alright. Any other question?
Yeah, good evening.
Yeah, good evening.
Please, it's not actually a question though. I just wanted to remind you that we both had a deal and they haven't get back to me, sir.
Alright.
And I just messaged you on Telegram now, sir.
Alright.
Okay.
Any other questions, please?
Yes, I have a question, please.
Go on.
I hope it's fine. This is regarding the last trade you took on gold. And usually, when you take trades like that, what I do is I try to analyze it myself and see if I'm able to spot whatever it is that you spotted on that particular trade. So the second to the last one you took on gold, I was able to see the FVG, the confirmation and everything. But the second one I couldn't. So I don't know if it is something you could maybe explain how you got the entry for that particular one, or maybe it was not FVG that you used, fair value gap that you used for
It
that
was
particular
actually
trade.
not. It was not a fair value gap. It was a
Oh,
mitigation block.
okay, that's fine
A
then.
mitigation block with inducement. Yeah,
I guess we'll be talking about that later on.
of course. Yeah,
All right then. Thank you very much.
yeah.
I have a
Um.
question.
All right. All right.
Hello? I have a question.
Yeah. Yeah. Go on.
Yeah. Yeah, I wanted to ask what do we base on to move our SL to break even, because sometimes we can get a
When do
trade
we
and
do that?
yes, yes, yes.
Actually, yes. It should be something I should be mentioning by now. But yeah. Anything from 3 weeks to reward on a normal day. An average trader. Let me not even say an average trader. In fact, if you search one of the best or top 10 best traders in the world, in as much as they are not true swing traders, the day traders, the average they do is 1:2, 1:3. So I used to say that 1:3 RR, a 3 RR trade is a very good trade, is a perfect trade. So once you have an average trade of targeting 5 weeks to reward, as soon as price is reaching that 3 weeks to reward, book partials.
Okay.
Personally is one of the things that actually helped me. But some people don't really see it as something that is proper. We have different preference. We have different things we are chasing. So if you feel like, oh, I don't want to take profit at 3 RR, if my target is 5 RR, then no problem. But whenever I take a trade and it's gone past 3 RR, it's a profitable trade for me. Regardless, I'm not closing that trade in a loss, regardless of what happens. At least, at least from that 3 RR that is running, I'll book partials. So sometimes it's structure and sometimes I use risk to reward. So for structure, when I say I use risk to reward is immediately price is running 3 hour. That means if I risk $100 and price is running around $300, I'll start taking partials. But if I don't want to use risk to reward, I can use structure. So for structure, if you have a bullish fair value gap, price mitigates the entry, you know the next high is supposed to be your take profit. So if you extend it past the next high, probably it's supposed to be 1:5. Let's say it's supposed to be five risk to reward. But sorry, hold on. Let's say your risk to reward is supposed to be five risks to reward, right? And that's where the supposed next high is supposed to be. No, let's say the next high was around three risks to reward, but you extended your take profit to like 5, 6, 7. So the moment price takes out that next high, you already know the job is done. For your target, once price mitigates a fair value gap and takes out the next high, that's your target. It has done its job. So if it's done its job, but you feel like, okay, maybe on the higher time frame or later, price can still take out the other highs or extreme high. But immediately price is taking out that next high, book partials. That's for structure. For structure, at the moment it's taking out the next high. For bearish, if it's taking out the next low. So did I answer your question? I'm still going to go deeper into this question.
Understood.
That's when we are talking about the strategy, the advanced part of the strategy and all. But for now, that's how I do it.
Understood. Understood. Thank you.
So I think I'll be rounding up here. Then I'll drop this thing. I'm
Hello,
actually very yeah.
hello.
Let's take it.
Good evening, sir.
Yeah, good evening.
Sir, please, I have a question.
Yeah, just go straight
I
into it.
I
Cool.
traded a Alpha Capital Group Profem, and I passed the phase one and two. So I'm having issue with the KYC. I don't know like if there's anyone that have passed the account now.
What KIC do you what document do you use?
You know, NI, that's what.
NIN, but it's not going through. Are you on the discussion group?
Yes, sir. That's still
Is it only me or I can't hear you clearly again? I can't hear you clearly.
His
I hear
network is
you now.
bad.
I hear you now.
Yes, I can manage. I said, are you on the discussion group?
Yeah.
Did you ask
I asked
anybody there?
question. Yeah, I asked question on the discussion group, and most of the people say I should try voters card, and I did not see any option of voters card for there. I only see ID card and driver license and international passport. So there's nothing
Yes,
like voters card
that's
there.
the one I'm familiar with. I'm familiar with
Mm.
international passports and driving license, and
Yeah,
sometimes some big NI. So your NIN is not working,
it's not working.
and you don't have international passport or driver's license,
No, I did not have driver license.
and that's the options that are there.
Yes, sir.
Oh my God, was there actually an option of NIN in the first place? Identification number, right? That's what they show.
No, there's no option. They even wrote it before you verify. You will see that they wrote it. They are not accepting NIN slip. They clarify that they are not accepting it.
I really don't know. I've never traded, and I'm not sure if I traded any Atlas this thing to pay out. I don't think so when I used to trade props. But The ones I use my international passports. Most times it's
Okay,
international. Yeah, so I really
okay,
don't know. I don't know. Maybe you can reach to their support
okay, sir. Thank
whatever
you, sir.
way. Yeah.
Okay, sir. Thank you, sir.
Mm.
Mhm.
Actually, today was very hectic for me. I just didn't want to cancel the class. So to the next week, after our new week view on Sunday, the next class will be Tuesday. Just for us to like practice and reflect on this class. So Tuesday will be the next class, anytime from 8:30 West African time, 8:30 p.m. West African time to 9 p.m. So I'm sleepy right now. I was kind of even dozing off because it's been an hectic day for me. So once the this thing will drop around, it might drop tonight, but I will have to drop it tomorrow morning. That's the recorded session, the recorded part of this session. So I'll be rounding up now. Have a nice day, everyone. Have a nice night ahead. Good night.